Let's bring in Erik Hirsch, co-CEO of Hamilton Lane, with roughly $986 billion in assets under management and supervision. Erik, good morning. Good to see you.
Frank, nice to be back.
All right, so just this report right here, some concerns out here by investors moving private equity firms like yours lower on the idea that they won't be able to sell their previous investments at good prices. Is that a trend that you're seeing?
Well, I think the concern right now is what we're going to see on the liquidity front. So your prior segment really said it all, which is you've got the public markets actually trading at all-time highs, extremely concentrated, but we're not seeing the same success right now in the private markets. Part of it is a timing issue, which is a lot of capital deployed in the last couple of years, and those assets are just not mature. And part of it is when you buy assets at high prices, you need to take some time to actually grow your way out of that to get those good returns. You kind of can't have two things being true at the same time. Prices have come down, so we're seeing fund managers more able to buy assets at attractive prices, but then that makes it hard to get liquidity if those asset prices are also low. So what you're sort of seeing here is a little bit of a tale of two cities, which is able to deploy capital right now is far easier than the ability to actually realize capital gains.
All right, so 401ks, a lot of people saw that as the holy grail for alternative investments. Do you agree with that idea? And do you think that we're going to see widespread adoption at the retail investor level when it comes to these alternative investments? Right now, of course, retail investors who are accredited investors have access to them. But just, the regular working people out there, do you see them adding it to their 401ks?
I hope so. I think right now we have a huge retirement challenge in this country. Outside the U.S., you're already seeing inclusion of the private markets in people's retirement portfolios. Inside the U.S., the 401k market, which is most Americans' way to save, has been completely locked out. Now, we're going to need to see some regulatory change for that to happen. The administration is already taking the first steps on that, but there are several steps to go before we actually see inclusion. Today, what you see for most Americans who utilize a 401k is a very indexed public market exposure, and that is their retirement tool. But again, as we've been talking about now for a long time, hugely concentrated right now, and very, very few number of tech companies really driving that. I don't think that makes for a great retirement portfolio. So getting the private markets in there, getting more diversification, I think is essential. I hope it happens. I think it will happen, but we've got some time to go here.
Erik, one other question before we let you go. So you're saying that you think that the high concentration of indexes make it kind of difficult to plan a retirement with that level of concentration, but the illiquidity of these alternative investments, isn't that concerning? I mean, right now we're in a secular bull market. We have been for over a decade. To have illiquid investments and the possibility of a downturn going forward, I think a lot of people might be left not holding the bag because you have the investments, but not able to retire the way they want to. Isn't that a real concern for a lot of people?
But I think if we look at pensions, Frank, pensions have actually been driving the bulk of their returns through private markets. If you take any pension fund around the United States that has actually done private markets, a huge portion of that excess return has come from the private markets. This is really a portfolio construction issue. Obviously, you wouldn't want to have a 75-year-old retiree hugely concentrated in relatively illiquid private markets. But if we're talking about a 25-year-old or a 30-year-old early saver who's getting that jump start on that retirement plan, having a portfolio that starts out heavier weighted in private markets, getting that excess return, and then begins to tilt over time to things that are more liquid, I think that would be a great way to go. So think about target date funds having private markets in them. Again, heavier weight in the early years, lower weight in the later years. I think that's a great solution. And again, the pension funds have sort of shown us that that can be done. It can be done very successfully, and that has been a big return driver for them.
By the way, we're going to get some tweets and emails from a lot of financial advisors with the target fund idea. Erik Hirsch, really a pleasure to have you on. Hope to have you back. Thank you.
Thanks, Frank.